Hi everyone. So in this video, we'll be looking into something new, a new investing instrument called bonds. So bonds are nothing but basically a way to generate fixed income. So previously, all the users were basically investing to get the fixed income. The most commonly known thing is investing in FDs. But the issue with the FDs is like the low returns that it generates and doesn't beat the inflation that is there. So bonds are a good means to invest directly in government agencies or private agencies and get good returns, good fixed returns, I would say. So it's not market linked, unlike investing in mutual funds or investing in stocks. This is more like a fixed return instrument and carries lower risk compared to the market linked things like mutual funds, stocks, and other things. But it also carries higher risk compared to FDs. Unlike you're investing in FDs in banks, which is which has a 5 lakh insurance, the bonds doesn't come with any such insurance. So if the investment wherever you are investing, whether it's a government entity or in a private agency, if that fails, then you are losing the money that you have invested. But that's less likely to happen, and there are other means and techniques which you can follow when you are making an investment, like tend to invest in a senior secured bond which is backed by certain things. So there are bonds like, for example, issued by Muthoot and other agencies which are backed by gold loans. So here there is a collateral which is like the gold, which is backing the bond which is being issuing. So which is being issued by the firm. So even if some mishap happens, then there is liquidation process that happens. They sell the gold whichever is backing that bond, and then they try to recover the amount that is being invested, and the priority is given to the senior secured uh, investors, and they get the money back. So how does the bond work? It is similar to how the FDs work. Instead of lending the money or giving the money to the banks, you are basically directly giving the money to the issuer of the bond, and which can be a government entity or a private agency like NBFCs and other uh, firms, and they pay you a regular interest on regular intervals, like it can be monthly, annually, or quarterly, depending on the terms of the bonds. Uh, so bonds can be short term, medium term, long term. So short term is like which matures within a few months, or medium term can be within 5 to 10 years, and long term is more than 10 years. It's ideal as a public investors to invest in bonds which are short term, and there are bonds which are senior secured, and there are bonds which pay you the principal back at regular intervals as well. In this way, your money is more like secured, and you are investing in a good instrument or a good company which gives you a better returns compared to FD. So typically the bond gives you 9 to 12% of returns, which is decently enough to beat the inflation and generate a good regular stream of income. And one thing to note while buying a bond is the credit rating. So a rating agency like CRISIL Care and ICRA, all these agencies basically rate the bond based on the company's uh, cash flow, profits, and etc. On what is the underlying assets, and all these things are looked into, and these agencies basically rate a specific bond which is available in the prospectus while issuing the bond. While why bonds? That is a good question. So previously, like mentioned, people used to only use uh, or basically invest in FDs to generate fixed incomes, which is hovering on the range of 4 to 7% in the market. Now, the next source of income, if you want to generate higher interest, is then comes as stocks or like mutual funds, which comes with higher returns but also has higher risks as well. Now, to invest and get a good return with good stability, bonds come into picture. So bonds basically give you higher returns than FDs, but slightly lower returns than the stock market. And then it also gives you the stability because it generates a fixed uh, return based on the coupon rate what the bond is issuing. And then the company is good, then there is less risk of the coupons or the interest rate meeting default, and there is slightly less chance of the capital to get managed. So that is why bond is basically being used. It basically offers predictability and stable income stream. That is the main thing. There are bonds which gives you tax-free returns and then a good diversification. So if you are someone who has already invested a good amount of money in the equity market, then bonds are something which someone can consider. Or if someone is basically only investing in FDs and planning to move to the equity side, then they can start building a position in bonds or start investing through bonds and then move slightly to a higher riskier thing, which is basically mutual funds or stock market investments. Then there are different types of bonds and different categories, which is like zero coupon bonds, fixed rate bond, floating rate bonds, municipal bonds, callable bonds, and all these things. But mostly like corporate bonds and other things. But the platforms we would be looking into it mostly offers fixed rate bonds issued by private agencies like or NBFCs, and there are credit ratings which you can see, and there are also government agents, government bond, but the which offers higher safety as it is being issued by government of India, but the interest rate on these bonds are also lesser. So that is the issue with the government. If you're looking for higher safety, then government bonds which are issued by the government of India is the best bonds. But consider that, like, since it comes with higher safety, then the returns are also less. Yeah. And then these are the advantages, the stability, portfolio diversification, and the limitations. So main limitation is basically liquidity. So unlike FDs, where if you have a urgent requirement, you can go to the bank and break the FD and get the amount of the capital that you have invested, and they only charge 1% or less of whatever tenure the FD was sitting there. So you still get the interest, but 1% less of whatever the actual interest rate for that period is, and you still are able to liquidate within a fairly good amount of time. But when it comes to bond, it is not that liquid compared to stocks or compared to the FTs as well, because there needs to be a buyer which who is ready to buy the bonds that you are trying to sell. So bonds are comparatively less liquid. So only invest in bonds, looking into the tenure of the bond and like considering that like you don't need that specific funds till the end of the bonds. That is the ideal way to invest in a bond, is what I think. Yeah, so that is the main thing. Look into the investment objectives, tenure of the bond, risk factor. The best way to look into the risk factor is going through the prospectus, where the balance sheet. If that all those things you feel like too much, then basically the least you can do is look into the credit rating and read through that specific document and Google about the company, see if the company is profitable. That is the least, and only invest. Let's say if you are having 10 lakh rupees, so don't invest more than 2 lakhs in a specific company, so that you can diversify your position in across multiple bonds or like multiple companies or NBFCs that are there. In this way, you carry less risk and less exposure to a specific company and a specific bond issued by a specific company. And yeah, you don't have to do much research. So the basic research that needs to be done is go through the prospectus, go through the rating agency's document and Google about the company and see if the company is profitable or not, and then invest in that company and diversify the position so that you are not investing too much into one specific firm just by considering the returns that they are offering. Yeah, so that's mainly it, and I'll basically introduce you to two main platforms through which I'm investing as well, which is one is WintWealth. So this is not a paid or anything sponsored video by WintWealth, or GoldenPI is the another platform which I'm using. This is just me sharing where I'm investing. Yeah, so here you can see there are so many senior secured bonds. So senior secured bonds basically is nothing but like you are the first preference. There is a bond. These bonds are backed by a certain collateral, and then if something happens to the company, you are the first person to get whatever money they are getting after the liquidation process. So this is having the highest safety when you look into the bond investment. So here you can see, to give an example of WintWealth. So this is how the dashboard looks like. So here are the popular bonds that are there, and click on view all. You see all the bonds that are there. So if we can look high returns bonds, you can see Profin is a company which is offering, and the minimum investment is 10K, and this is triple B plus. You can click on this and you will be able to see all the details. So and just scroll down and you can see other bond details. So you can see the company details, what Profin is, what they do. You can also Google it rather than looking just into the overview which is being offered by the platform. You can basically Google and know more about the company, what they are doing. And this is an unsecured MSME loans, that is the collateral type. So it is a senior secured bond, but it is backed by unsecured MSME. There are bonds which are backed by gold loans, which are having higher stability, because gold as an asset is backing the bond rather than a MSME loan. And you can see this bond is having a triple B plus rating, which is being issued by ICRA. And it's a fixed rate bond. The bond tenure is 18 months. And it is also listed on BSE. And so all these bonds are basically listed. So you can directly sell the bonds through the platform, or directly go to your Demat account and make a sell order from there as well. And you can see the coupon rate is 11%. So this bond, if you're investing 10,000 rupees, you are basically getting 11% on that, which is a good investment return. Unlike FDs where you are only getting 7%, here you can basically earning more than 4% by investing in this bond. And it is only for 18 months. So the maturity date is 30/7/2027, and it's a senior secured bond. So these are the basic things that needs to be looked into. You can look into the financials. You can see the net worth that is there. You can see the AUM, how it has been growing. You can see the profit PAT, profit after tax. You can see the debt to equity ratio, and you can see the GNPA and NNPA, and all these things are there. And you can see the rating agency, like what they are offering. So triple B plus is the bare minimum which one should look into. A plus are the other ratings which are good from company's point of view. And all the documents like financial statement, price calculation, key information documents, credit rating documents, this is something which you need to look into. And rest of the things can be good. Financial, if you are good at, if you know everything, you can basically go through the financial statement. Otherwise, see if the company is doing well, what are the latest news about the company, and look into the credit rating document in detail. Yeah, all these other documents are also important, but considering if you are a beginner, this document plus a general idea about the company is what matters the most. It is what I do when I started investing in through bonds. Yeah, so this is all about WintWealth. I'll share the link below in the comment section. You can use the link and start your investment journey through WintWealth. Now the other platform is basically GoldenPI. So GoldenPI is also a similar platform which is similar to WintWealth, but they are having a different set of bonds as well. Some companies are not listed in WintWealth. Some companies are listed in GoldenPI. So depending on what your investment amount is and all those things, you can basically select the companies from here. So you can see here we have bonds issued by firms like Akara Capital, where you are basically getting a return of 12%, which is fairly good. Considering the stability and other things that the bonds are offering, the 12% return is decently good, which you can earn as a fixed income. So here is something like Akara Capital, which you can consider investing. And here also you can see they are having a triple B stable rating. It's a secured, senior secured bond. So far there hasn't been any defaults. These are the key strengths. These are the weakness of the bond. Here also you can see how the revenue has been growing for the company. The PAT has been growing. The net worth of the company has been growing, and all those things. And then basically you can go through all the other important details which are being issued by the bond issuer. And one thing like mentioned to note is, rather than just looking into the prospectus and whatever the platform is have written over here. It is our responsibility to make sure that wherever we are investing, the amount is kind of safe, and we are having doing the diligence before investing any of our funds. So make sure you diversify. Don't invest if, let's say, like for example, you are planning to invest 10 lakhs. Don't invest more than 2 lakhs in no specific firm, so that your exposure is limited, risk reward ratio is limited, and do a good analysis about the company before making that investment. So I'll share the links for both these things, and you can start considering investing through both these platforms. It's a good way to start your journey in bond investment. All you need is a demat account. If you're starting through GoldenPI or WintWealth, it provide the demat uh, uh, with zero cost or anything. So yeah, so if you're someone who has already invested in stocks and FDs, or someone who has just invested in FDs and considering something better, uh, these are the two platforms, or bond investment is something which you can consider. So that's all in this video. I'll come up with a new video, a new way to invest, and we'll learn together in the next video. Okay, thanks.